Have you ever wondered who actually owns America's massive national debt? A big chunk of it, trillions of dollars, is held by foreign governments. Japan, China, the UK. They're all major players. For decades, this has been seen as a sign of the dollar's strength. Countries trust the US to pay its bills, so they buy US Treasury bonds as a super safe investment. This helps keep interest rates low for Americans, making it cheaper to get a mortgage, a car loan, or for businesses to expand. It's a system that has, for the most part, worked beautifully. The US gets the cash it needs to run, and other countries get a secure place to park their money. Everybody wins, right? Well, what happens when this cozy relationship starts to show some cracks? That's what we're going to dive into today. What are the real risks when so much of our debt is in foreign hands? The biggest and most talked about risk is what economists call sudden stop risk. Imagine one of the major holders, say China or Japan, decides to suddenly sell off a massive amount of their US Treasury holdings. Why might they do this? It could be for a variety of reasons. Maybe their own economy is in trouble and they desperately need cash. Or more worryingly, it could be used as a political weapon during a major geopolitical disagreement. Think of it like financial warfare. If they dump trillions of dollars of US bonds onto the market all at once, the basic law of supply and demand kicks in. The supply of bonds for sale would skyrocket, causing their prices to plummet. Now, here's the crucial part. Bond prices and interest rates move in opposite directions. When bond prices fall, interest rates or yields have to go up to attract new buyers. So, a massive sell-off would trigger a rapid spike in US interest rates. What would that mean for the average person? Suddenly, that mortgage you were about to sign for gets way more expensive. Car loans become unaffordable. Credit card interest rates shoot through the roof. For businesses, the cost of borrowing to invest in new projects or hire more people would become prohibitive. This could easily slam the brakes on the entire US economy, potentially pushing it into a deep recession. The US government itself would also feel the pain. It would have to pay much higher interest on all the new debt it issues, which would make the national debt problem even worse. It's a domino effect that could destabilize the entire US financial system. Another angle to this risk is a slower, more gradual shift away from US Treasuries. This isn't a dramatic, overnight sell-off, but more like a slow bleed. We're already seeing signs of this. Over the past decade, some countries, including China and Russia, have been gradually reducing their holdings of US debt and diversifying their reserves into other assets, like gold or other currencies. This trend is often called de-dollarization. They're trying to reduce their dependence on the US dollar and insulate themselves from US financial policy and sanctions. While this slow trickle doesn't cause the same immediate panic as a sudden stop, its long-term effects can be just as significant. As more countries reduce their demand for treasuries, the US government has to find other buyers. If foreign demand dries up, who's left? Primarily, domestic investors and the US Federal Reserve. If the Fed has to step in and buy up huge amounts of government debt, a process known as quantitative easing or money printing, it can lead to inflation. More dollars are being created to buy the debt, which devalues the dollars already in your pocket. So your cost of living goes up and your savings are worth less. This slow shift also erodes the US dollar's status as the world's primary reserve currency. For decades, the US has enjoyed what's been called an exorbitant privilege because of the dollar's dominance. This privilege allows the US to borrow cheaply and have significant influence over the global financial system. A gradual move away from the dollar threatens to chip away at this long-held American advantage. Now let's talk about the hostage scenario. This is a more subtle but equally potent risk. When other countries hold a lot of your debt, your foreign policy decisions can become complicated. Let's say the US wants to impose tough sanctions on a country for human rights violations or aggressive military actions. But what if that same country is one of the top 3 holders of US debt? The US government might hesitate, worried that an aggressive move could provoke that country into selling its bonds and destabilizing the US economy. In essence, our economic vulnerability could be used as leverage against us, potentially limiting our ability to act on the world stage according to our values and interests. It's a situation where our creditors could indirectly influence our political and security decisions. Our economic interdependence, which once seemed like a source of stability, could become a chain that restricts our freedom of action. This doesn't mean the US is completely powerless, but it adds a layer of complexity to international relations that policymakers must constantly navigate. So with all these scary scenarios, is the sky falling? Should we all be panicking? Not exactly. It's crucial to look at the other side of the coin. The reality is, the global financial system is incredibly intertwined, and this creates a kind of mutually assured financial destruction. For a country like China to dump all its US treasuries, it would not only hurt the US, but it would also massively harm itself. Firstly, selling off trillions of dollars in assets would cause the value of their remaining holdings to crash. They'd be selling at a huge loss. Secondly, the ensuing global economic chaos would wreck the economies of their biggest customers, including the US and Europe. If no one can afford to buy Chinese goods, the Chinese economy suffers immensely. Furthermore, there's a simple question: where else would they put all that money? US Treasury bonds are still considered the deepest, most liquid and safest financial market in the world. The Eurozone has its own set of political and economic challenges. The Japanese market isn't large enough. Investing trillions in gold is impractical. So, despite the risks, there aren't many good alternatives to the US Treasury market for countries looking to store vast amounts of wealth safely. This lack of viable alternatives gives the US a powerful, persistent advantage. It has a complex balance of power where both sides have a vested interest in keeping the system from collapsing. So what's the big takeaway here? The massive foreign holdings of US debt are a classic double-edged sword. On one hand, they have enabled decades of low interest rates and funded the US government. They are a testament to the world's faith in the US economy. On the other hand, this dependence creates genuine vulnerabilities. The risk of a sudden sell-off, a gradual diversification away from the dollar, and the potential for financial blackmail are all real concerns that shouldn't be dismissed. The key for the US is to not take its privileged position for granted. Strengthening the domestic economy, getting the national debt under control, and fostering a stable and predictable policy environment are the best ways to ensure that US Treasuries remain the world's most attractive safe haven asset. It's not about eliminating our connection to the global economy, but about managing the risks that come with it. The world is changing, and America's role in it will depend on how wisely it navigates these complex financial tides. Thanks for watching, and if you found this breakdown helpful, be sure to like this video and subscribe for more deep dives into the world of finance and economics. See you next time.